It's 1:30 p.m. in Lagos, same time in London, and we're bringing you markets, insights, and analysis on Business Incorporated. Here's what's coming up on the program. South Africa business activity drops again in July. And Ghana accelerates plans to install first nuclear plants by 2023. And Ethiopia's Eurobond under pressure as coupon payment looms. Hello and welcome to the program. I'm Will Ibang. Thanks for watching. We'll start off with numbers from Africa, where markets were mostly negative at intraday for equities in Africa. Nigeria's NGX was the lone gainer there, up 0.9%, almost 1% at intraday, still settling at 64,000 level there. But however, in South Africa, it was 0.42% down, almost 0.5% to close at 76,158 points. If we look at Egypt, the EGX 30 is trading down marginally by 0.1%, while Kenya closed Wednesday's session deeply in the red. Now let's go over to the Middle East, where we saw negative sentiments at intraday. Abu Dhabi was down slightly, 0.06%. Dubai, however, was down 0.79%. Elsewhere, still in the Middle East, we see Saudi exchange down 0.4%, and the Qatari index was down triple digits, 1.68%. Now, Russia is ramping up attacks on ports in Ukraine to prevent it from exporting grain, and that's sending global food prices higher. Joining us with more is Deutsche Welle's correspondent Chimbelu is there in Berlin to give us the updates. Chimbelu, how have Russia's attacks changed in recent weeks?
Well, Russia has intensified its attacks on Ukrainian ports. That's what at least the latest information from Kyiv shows. Russia has attacked 26 port facilities and hit 180,000 tons of grain in 9 days of strikes since quitting the grain deal. Ukrainian officials say the aim of the strikes is to persuade shipping companies and insurance companies as well that Ukrainian ports are unsafe. After Russia quit the grain deal on July 17, Kyiv had said it would try to find alternative routes to export its grain. And there are some options. For instance, there's the port of Izmail on the Danube River, which has now become the main route out. It already accounted for around a quarter of Ukrainian grain exports before the grain deal ended. And now Moscow seems to be set on preventing Ukraine from exporting grain. It says it would treat ships heading to Ukrainian seaports as potential military targets. Now, Ukraine's President Volodymyr Zelensky says Russia is waging a war, or rather a battle, for a global catastrophe and needs the world food markets to collapse.
This is so sad to hear, but what attempts are there to secure global food supplies?
Well, the UN has said it is talking to the parties involved. Of course, it has also warned of a potential food crisis, and it was initially involved in, brokering a grain deal between Ukraine and Russia. And apart from that, we also know that Russian officials, or the Russian president, the Russian president and the Turkish president have been speaking. The Turkish president was also involved in brokering the initial grain deal. And we've heard that Russia's President Vladimir Putin has said that Moscow wants better conditions for its own food and fertilizer supports. Now, it is something that Russia was pushing for before quitting the deal. And while Russia has been able to export grain and fertilizer, the fact is that it is cut off from SWIFT, the international payment system. So that means that it is very difficult for governments across the world to buy its goods and products. So the ramping up of attacks on Ukraine is really seen as an attempt by Moscow to undermine sanctions by threatening the global food supply. And millions around the world could be affected as a result. For instance, just one attack south of the Ukrainian Black Sea port of Odessa in Chornomorsk destroyed 60,000 tons of grain. That would have been enough to feed more than 270,000 people in a year, according to the World Food Program. So the stakes are high and rising. Every day there is no agreement about how to get Ukrainian grain exports out more safely.
60,000 tons of grain. That's a whole lot of grain there to be destroyed. But what can we expect from markets today?
Well, European markets are expected to be trading lower, and that also includes the DAX, Germany's blue chip index. The latest figures show that German exports rose 0.1% in June compared to May, and the exports were down 1.9% compared to last year, June. So that's not a positive development, of course, for an economy that has stagnated in the second quarter. Today, also investors will also be watching the Bank of England's interest rate decision. And then there's three German blue chip companies reporting earnings today. There's BMW, Adidas, and Lufthansa.
Thank you so much, Chimponder Chimbelu, for those updates. We'll keep track of what's happening. Thank you. Now we go over to the UK, where it's a big day for the country as the Bank of England hikes interest rates by 0.25%. And this is the 14th consecutive rate hike by the Bank of England. Teniola Oyetayo joins me from London. Tenny, this wasn't an easy decision for the committee to make, was it?
Hi, Will. No, it wasn't. In fact, the 9-person MPC was split on the decision, with 2 members voting for a bigger increase and 1 member voting to keep the rates on hold. The good news, though, is that the increase was just by 25 basis points and not 50, as some had expected, and as I spoke to Inni about earlier. But whether there's an end to the rate hike in sight, it doesn't seem there's going to be a hold anytime soon. The bank has signaled for the first time today that it would keep interest rates elevated for some time. And while the BOE still expects inflation to slow to around 4.9% by the end of this year, the prediction is that the UK won't hit the target of 2% till between April and June 2025. So it's still a long way to go. But the positive news, though, is that the Bank of England is still firm that the UK economy will avoid recession, but growth is still expected to be slow.
Clearly, the populace is displeased with this because before this rate hike, we saw demonstrators were seen outside the Bank of England ahead of this decision. What were their demands? Could you tell us about that?
Well, people are, of course, unhappy with the rate hikes, and a campaign group called Positive Money led protesters outside the bank today to voice their concerns, with many criticizing the rate hike, saying it's damaging to the common people and it's only wealthy people that are benefiting. 5.25% is the highest rate since March 2008, and it's going to add to cost of living pressures for households. This rise also puts more pressure on the housing market, where we have to remember prices are already falling at the fastest rate in 14 years. So people are really, already unhappy with the situation of things. And as the rate hike continues, we're likely to see more protests like this springing up.
I think one of the demands we could see that they're calling for maybe some windfall. What do you think, Teniola? Then with prices going to be, prices will keep rising, and the Bank of England is saying they're going to keep interest rates elevated. What do you think? Do you think a windfall from maybe banking stocks or from the banking sector, the oil and gas, should be the appropriate thing that should be given to the people, or for them to benefit from this?
Yeah, that's actually one of the demands. If we recall, last week, Shell and BP were one of the companies posting huge profits. And people are saying, these companies are benefiting, but ordinary people are still suffering amid the rate hikes. Ordinary people are still suffering from the cost of living crisis. Yesterday, we spoke about the fact that, millions of people are still missing out on bills, energy bills. In times where energy prices are meant to be lower, we're seeing the same rights as seen during the winter period. So people are really unhappy, and they're saying the government needs to do more to help the ordinary people at this time.
Definitely, Dad. So how are markets reacting to all of this?
Well, the markets got a slight bump from the, as expected, rate hike, but it remains firmly in the red at intraday. The FTSE All Share is down 0.61%. FTSE 100 is also down at 0.72%. In the domestic market, the FTSE 250 is flat. In the currencies market, the pound sterling is also struggling today, hitting a fresh 1-month low. It's trading down against the US dollar by 0.49%. It's also trading down against the euro by 0.38%, as well as the Japanese yen by 0.75%. Well, it's not really the best day today for the markets.
It's not really the best day, but we can only hope and pray and wish that tomorrow will be better. Thank you so much, Tenny, for that update.
Thanks a lot, Will.
And now we'll move over to Asia, where markets were mixed on Thursday as Wall Street saw a sell-off after ratings agency Fitch downgraded the U.S. long-term credit rating from AAA to AA+. Hong Kong's Hang Seng Index dropped 0.42% in its final hour, while mainland Chinese markets reversed earlier losses. We see the Shanghai Composite closing up 0.58% at 3,280.46 points. See the Australia ASX 200, however, down 0.58%, and we're seeing that pace for Japan's Nikkei 225 tumbling 1.68%, leading losses in the region and closing at 32,159 points. South Korea's Kospi fell 0.42 to finish the day, and we're seeing that the country's Australia, if we go back to Australia, the country saw its June trade balance coming at a much lower rate than expected. Now we'll move over to the U.S., where stock futures slipped early on Thursday as traders continue to assess the fallout from Fitch's recent downgrade of United States long-term rating. Futures tied to the S&P 500 fell 0.25%, while NASDAQ 100 futures dropped 0.39%. Dow Jones Industrial Average futures dipped 0.17%. Now, on the economic front, traders are gearing up for weekly initial jobless claims, as well as durable goods orders. The focal point will be Friday's July's payrolls report. Now we'll go over to the oil space, where markets prices rose slightly in early Asian trade on Thursday as markets weighed bullish U.S. inventory data on Wednesday and its likely extension of OPEC Plus output cuts. Brent crude futures rose 0.32%. To $83.47 a barrel, while U.S. West Texas Intermediate crude climbed 0.36% to $79.78 a barrel. Both benchmark had been trading at near their highest levels since April on Wednesday, but closed down 2% amid risk of investor sentiment following the U.S. ratings downgrade. Also, according to the Energy Information Administration, U.S. crude future stocks fell by a record 17 million barrels last week as refiners stepped up runs and exports topped 5 million barrels per day. Meanwhile, the next Market Monitoring Committee meeting of OPEC Plus is scheduled for August the 4th. Now, gold prices held near 3-week low in early trade on Thursday after a larger than expected increase in U.S. private payrolls in July fueled bets on more monetary policy tightening, boosting the dollar and bond yields. Spot gold was up 0.2%, trading near its lowest level since July the 12th. U.S. gold futures fell 0.1% to $1,972.90 per ounce. Spot silver, however, was down 0.2%. Platinum dropped 0.2%. Both metals were at their lowest levels in about 3 weeks. Palladium prices fell 0.2% to $1,240.51 per ounce. Next, more updates from the commodities market space. Stay tuned. This is Business Incorporated. Welcome back. Now, The aftermath of the subsidy removal and full deregulation of the downstream petroleum sector in Nigeria has led to a 235.5% spike in the price of PMS, while the price of diesel, however, remained fairly unchanged. However, recently, the price of diesel has spiked by 5.88% to 720 naira per liter from 618 naira per liter in June. Joining me is to discuss this is Miriam O'Day, analyst with Financial Derivatives Company. Miriam, what would you say is responsible for this rising price, seeing that subsidy on diesel has been removed way long before we ever saw the subsidy removal on petrol, on PMS? So what's driving this sudden hike in the price of diesel?
Good afternoon, Will. Thank you for your question. So, diesel has been deregulated in the Nigerian economy since 2009, which has allowed for the effective play of demand and supply dynamics in this market. Recently, we have seen, as you said, a 5.88% rise in the price of diesel to about 720 naira per liter. This is due to two main factors, which are the elevated oil prices and the exchange rate depreciation. So since the unification of the multiple exchange rates in the country, the naira has lost 40% of its value at the I and E window. And when using the exchange rates for computing import duty, has lost 23.5%. So as we all know, Nigeria is a major imports most of its refined petroleum products to meet up with domestic demand. About 90% of refined petroleum products used in the country are sourced from the international market. So it's not surprising to see that this depreciation of the naira has resulted in a rise in the domestic price of diesel. Also, oil prices have been bullish for the past 1 month due to investors' expectation of additional output cuts by top producers, Saudi Arabia, and they're expecting an extension of these output cuts till September. So this has spurred supply concerns in the market and has caused oil prices to remain high. We know that diesel is gotten from oil, it's a product of oil, and so it is likely that this rise in oil prices will translate into the rise in the domestic price of diesel as we are seeing now.
Interesting point there. But interestingly, we're seeing the average global price of diesel remaining constant in July at $1.23 per liter, despite the spike in global oil prices, which was at a 3-month high of about $85.45 per barrel during the period. Could this be a result of global competition? And do you see this competition normalizing the domestic price of diesel anytime soon?
Yes, the global competition in the energy market has helped to keep the average price of diesel relatively stable. But it's important to note that this competition is not within the diesel market, that's the global diesel market, but rather between the diesel market and other alternative sources of energy like renewable energy. Already in the global space, we're seeing a transition into renewable energy such as wind and solar, and 52% of Germany's electricity consumption is already sourced from renewable energy. So there's this transition towards renewable energy, and that is building competition in the global market. If we also see it from another point of view, the consumers in the global market are already switching towards the use of energy saving or energy efficient devices, which although is not a complete transition or a transition into renewable energy, but is reducing the consumption and demand for diesel. Producers of diesel have started to realize this and are now put in a tight spot as they are unable to take advantage of the elevated oil prices, which are at a 3-month high, as you said. And so they now have to opt for cost saving and innovative ways of reducing prices or keeping prices, of keeping prices stable. And this will trickle down into the Nigerian economy, and coupled with the rising demand for CNG gas, which is another alternative for diesel, will weigh on the demand and price of diesel in the short term.
And we've also seen the shift from fossil fuels to alternative energy like solar and other renewable energy moving at a very fast pace. We've seen countries ramping up their investments, following their pledges, following their, their investments in renewable energy, alternative sources, sustainable energy, following their pledges at the COP27. What is the implication of this increased investment in renewable energy on energy security and the long-run outlook for the price of diesel?
As I said before, there's a rising demand for renewable energy, and this is why we can see producers or investors trying to move into that space and take advantage of the growing renewable energy space. We can already see that last year in July 2022, there was a quick shift or a quick rise in the demand for renewable energy, such as solar, due to the spike in diesel prices, which tripled to about 800 naira per litre. However, despite this price surge and the subsequent increase in the demand for solar panel adoption was still below 2%, which is quite low. And this was due to two main factors, which are the supply constraints that businesses had to be able to meet up with the rising demand for solar in the country, and also the increasing businesses opting to use diesel generators instead of solar power generators due to its rising cost. To throw more light to this, generators in the solar power generators are more effective and more expensive, and account for about 5 to 10% 10% of the cost of diesel generators. So you can see why businesses were not so quick to switch to the use of solar panel generators. However, as this demand or this trend grows in the domestic space, it will also trickle down into the domestic environment, and we'll see investment into the renewable energy space grow. And when this grows, we will see supply of solar power generators or solar power equipment increase, which will enable domestic solar businesses to be able to meet the demand in the country. And as this increases, it will help to diversify Nigeria's energy sector, which is currently heavily reliant on fossil fuels. While this happens, Nigeria's energy sector would become more resistant to domestic and global disruptions. Yes, domestic and global disruptions, and would reduce the demand for diesel, which is spurred by businesses that are trying to fill in the electricity deficits in the country.
So basically, Miriam, what you're saying is that lack of funding, financing is the issue here, is the elephant in the room for Nigeria's shift to solar or any other renewable energy in the country. So if we get the necessary investments, we're able to make that shift and be less dependent on fossil fuels, right?
Yes, exactly.
Okay, so thank you so much, Miriam O'Day, for those perspectives, for that insight. Miriam O'Day is analyst with Financial Derivatives Company. Thank you so much for coming on Business Incorporated.
Thank you.
Now we go over to Ethiopia, where the dollar bonds are under pressure amid concerns over the nation's debt profile. Ethiopia has a 33 million coupon payment due on December the 11th on its Eurobond, with a $1 billion principal amount to mature in December next year. Ethiopia's risk premium over U.S. Treasuries has been rising since March to trade at its highest level in nearly 9 months, well above the 1,000 basis points regarded as the threshold for being in debt distress. Now, the country is in talks with the IMF about a loan of at least $2 billion. It has a total debt of $31.6 billion and only enough foreign exchange reserves to cover half a month's worth of imports, according to IMF data. Now in Ghana, the Nuclear Regulatory Authority, NRA, is accelerating the acquisition of its competencies to oversee the country's plans to install its first nuclear power plant in 2030. The authority is currently training its staff overseas with support from the United States Nuclear Regulatory Commission. The enriched competencies will feed into the authority's work in developing regulations, guidelines, and standard review plans to conduct the authorization process for the full life cycle of the nuclear power plants. Now, South Africa's private sector activity is contracted for the fifth consecutive month in July as rising prices and weak business confidence weighed on demand. The S&P Global South Africa's Purchasing Managers Index PMI dropped to 48.2 in July from 48.7 in June. According to survey, rising fuel prices and a weak currency continues to drive input costs higher, while the rate of inflation quickening slightly meant South African firms pass costs on to customers. Also, ongoing rotational power cuts implemented by state power utility Eskom continue to affect business conditions as firms reported a lack of orders from clients due to outages. And that's it on Business Incorporated for today. Thanks for watching. I'm Will Ibong. We'll see you tomorrow.